Here we are, another Ask Me Anything Wednesday. Welcome. We're here, we're together, we're ready to rock and roll, answer all your questions. So start popping them in the chat. We got half the Brady Bunch here, we got half the people in Utah. Let's have some fun together. Give us all your questions, and we will do our best to answer them and answer some that you're not even asking yet because we can read your mind. Let's go.
All right, it is happy hour. So cheers to everybody. I'm in the Sky Club in Atlanta right now. Joe's in the Sky Club in Buffalo right now. We're headed out to Money Tank. But it's I know it's noisy here, so I'm gonna mute myself and
engagement.
Have some fun here.
Got any questions? Got anything you need to hear from us about? Go ahead and put those into the chat box, the comment box over there. Go ahead and let us know what we can help you guys with when it comes to infinite banking, anything IBC related, HELOCs, all that kind of stuff. That's what we're here for. So go ahead and use that. And if no questions, we'll mix them up. Here at the Money Multiplier, we're a full team of people, and we have different team members for different aspects of infinite banking, which in my experience is very different than a lot of other IBC practitioners. They have only maybe a handful of people at their firm that do infinite banking. All we do is infinite banking. And we have team members that focus on each step or each phase of putting it in place. That's why we do a lot of volume. It's why we help a lot of people and have a lot of repeat clients. So you're going to work with a mentor, with an application specialist. You're going to work with an implementation specialist. So that question comes up a lot, by the way, on our calls is like, okay, who am I working with and what's the process? Well, you're going to work with specialists on each area of that. So that's why we're able to help people streamline that process. So kind of something I've been talking about.
Well said, Fouts. It's I like to tell people, like, look, everyone on the Money Multiplier is actually a practitioner. So that makes it, oh, there's Miss Shauna. Hello, Shauna. Everyone say hi to Shauna in the chat, in the comments. Drop your comments, and we need some questions, folks. And, for Brian, what you were saying is everyone's a practitioner. So every single person you talk to has at least one policy, if not more. So you just know that we're living what we're teaching, right? More than anything. And the reason I partner with these guys is I always say, I'll ask you guys, do you believe that knowledge is power? Yes or no?
No.
You got some head? Okay, we got some. We got 2 yeses. We got a no. We got another yes.
I always say knowledge is power, but knowledge plus action is powerful.
Yeah. So knowledge. I mean, it's nice to have knowledge, but unless it's applied, nothing's going to happen, right? So really, when you get to the implementation stage, like I talked to someone today who started with us a couple years ago, and I don't know exactly what happened. I don't think he was ready. He's starting again now, but he wasn't ready a couple years ago, which is all right. He got it put in place. He didn't know what it was for. He didn't know how to do all the things at the end. Never connected with the implementation specialist. That person is there to literally be your student driver. This is how you take a loan out. This is how you pay a loan back. This is how you make policy changes. They're there. This is how you read your dashboard. They're there to help you use it. It's not complicated, but it sure is nice to have someone hold your hand when you need it, right? So,
absolutely. All right, so J-Rock asked a good question. Should you buy a home and pay it off or invest all that money and rent? I have chosen to rent and do private lending, but that's taxed as ordinary income, and I borrow from my policy, kind of a catch-22. So I think what he's asking is, should you, buy a home and pay it off or invest all that money and then go and rent instead? So I'm assuming that when you say buy a home, you're doing a down payment of $100,000, $200,000, something like that. You're looking at, instead of doing that, taking that money and then renting. I know Joe's going to have a pretty good input on that because why not do both? Why not have a house and also invest? Do both, not one or the other, and do infinite banking as well at the same time. All three. So Joe, you want to maybe elaborate on that one a little bit? Because you're the HELOC guy.
Well, you're doing awesome. I thought you were going to run with it.
Well, I can run with that if you want to. So, but anyway, yeah. So Joe and I have talked about HELOCs on these calls before, and also on the Wednesday ones. But the interesting thing, Jack, what you could do is go buy a home. When you put that money into it, access it back with a HELOC. So now you have the home. Homes have value just because it's a home. You're not just throwing your money away into renting, because when you put money towards rent, that money's gone. You're getting no value, no appreciation, nothing. So that money is just burnt up. You borrow that money back through the HELOC, and then guess what you can do with that HELOC money? You can go invest it. go put that money to work private lending, or take a portion of it and go fund an infinite banking policy and do the same thing with the infinite banking policy. So what you're doing when you do that, and keep in mind, this is a strategy. You're layering different concepts together to help your money work harder for you. So it's not one or the other. It's this and this and this, called the and method. And by doing that, your money's going to work a lot harder for you. So obviously, this is a very general overview. Joe, if you want to add some more flavor to that, go for it.
What is it, Craig? And
Andy.
Oh, you
well,
too.
that was another webinar that Jason and Greg and I did. That was the and. Everything that we had was and. So we were using the HELOC and the IBC policy and utilizing it that way in tandem. But just to go on off of what Brian says, you might as well utilize the money inside the 2x4s. That's called equity. Put it to work in the HELOC. Take the HELOC, run it through the policy, take the policy, put it into an investment, have the investment come back around, and you can do it all. And. Just like Jason says, oh, look at his hands are going, he's clicking and popping, and there goes the numbers, and that's how to do it.
And Joe, we bring this up a lot where, especially for J-Rock, if they're going into a brand new loan, there are different loans out there. You can go with your traditional mortgage where you've got the high volumes of interest up front, yada, 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 not much access. But I would recommend you look into what's called a first lien HELOC, because ultimately that will give you the most flexibility, where you can put your money, you can use it as a one-pot system, as Joe always calls it. All your income goes in there. All your expenses get paid out of there. You have the ability to pull out equity and use it for lending. You can put it back in. So you have a lot of control and flexibility. And so that's what I would focus on, is investigating a first lien HELOC. Sometimes they're called all-in-one, but look at those products if you are going to buy a home, because that's going to give you the ultimate flexibility and control.
Some people are not aware that they can actually purchase a house with a HELOC. They say, Shauna says it, you still don't get it. But there are products out there, people. There are products that you don't need to have a mortgage first. You can actually buy the house with a HELOC on day one.
We just did that.
And I'll show you how to do it.
We just did that with Joe. You and I helped a couple, right? A young kids, young couple. They were selling one house, buying another, and instead of buying the second house, we used a HELOC to buy the house. So
there you go.
Crazy. It's a cool concept.
Yeah, totally cool. So, right from the day one, Carson, right from day one, you're only going to leave 10% in the 2x4s. So you're getting a 90% equity value right off the bat. So you only have to put 10% down. And usually with a conventional, you have to put 20%, right?
Yeah.
See?
I got called this week by just a telemarketer, and they were working for a mortgage company. And I was like, let's just hear this guy out. Sometimes you got to just do that, right? So this guy started talking to me, and he was asking me about what if I want to buy a home soon, where I want to buy a home, what's the price range. And I asked, I don't know if I want to get a regular mortgage. I'd love to just get a first position HELOC and close on the home that way. And he was like, what do you mean? And I was like, well, I want to get a HELOC and buy the house. And he's like, you have another property you want to pull a HELOC from to buy a house? I was like, no. No, I want a HELOC to buy the house. And he was like, that's not possible. And I was like, all right, well, when you guys can make that product, you guys can call me back. And he was so confused, but it was crazy. He literally, a mortgage officer, didn't even know what I was talking about.
Well, Carson, I'm not surprised. That'd be similar to calling somebody up at one of the big four insurance companies and be like, hey, I want IBC. And they'd be like, oh yeah, I can help you. Yeah, but you won't have cash value to after year 3 or 4, right? Like, it's just people don't know what they don't know. Like, you really have to go down a rabbit hole to be here. Like, everyone here, we all went down the rabbit hole. I had a woman yesterday. You guys will appreciate this quick story. Older woman, super cool, came through one of our great partners. And the first sentence she said to me is, this is too good to be true. I don't believe this is real. And so I spent 10 minutes just telling her how it was not going to work. She was not the right fit. And I don't even know if we should continue the conversation. And I gave her examples. I was super nice about it, but I was like, hey, if you don't believe this will work, then this will never work.
100%.
Yeah, Jason, we all went down the rabbit hole and none of us have come back out yet, have we?
No, no.
We're still falling.
Just learned that about buying a house with a HELOC. This is the first time I've even heard that being possible on the buying end. Like, man, I wish I would have known that 2 years ago. I'd be in a very different place with my investment.
All right, next question we got here. All right, Aaron says, I'm 24 years old. I have some debt that's on its way to be eliminated around July. That's awesome. Having a baby on the way, August, though. Don't have that much money to put towards IBC, but can definitely put something. Should I start now with the baby on the way where money will be tight, or more toward the future? So everybody has a different opinion on that one, Aaron, to be honest, but you got to kind of look at your situation. Obviously, we don't know your cash flow. We don't know your expenses, income, all that kind of stuff. But to get an idea of sort of like the minimum that we look at when it comes to starting infinite banking, it's 10 times your age per month is usually where we start. So at 24 years old, $240 per month is typically kind of like the starting point. So you can always start there. Now, one thing also to keep in mind is how much do you have to actually pay out of $240 per month? It's going to be around 30 to 40% of that is what your minimum payments are. So kind of keep that in mind. So you do have some flexibility, but the best thing to do would be to hop on a call with one of our mentors and kind of go through your situation, your expenses, cash flow, income, all that kind of stuff, and just see what makes sense. So because you're young, you don't have to start today. You can always start a few years down the road because you are young. If you were 54, it might be a different answer, to be honest.
Yeah, and Brian, I appreciate that, you know, what you're sharing, and I would say at the same time, you know, Justin, it really depends on where you're at. Like, our favorite two words here are "it depends." So if you're coming into a call, like if you're coming into a call and say you're young, right? So I'm doubting you have this much debt, but say you come into a call and you have $120,000 worth of debt, and that's your goal, is to pay that off, to recapture that interest that's going to other people. If you're thinking that $240 a month is going to solve that, do the math, right? That's you know, that's only $2,400 a year. And, you know, you have way more debt. So over 10 years, you're putting in $24,000. You're not going to be able to knock that debt out forever. You won't focus on it. It won't work. So there's going to be other things that you would want to do first. And I'm just making up an example, but there'd be other things you want to do first. Like, how do you get more resourceful? How do you create more income? How do you put more into us to solve that problem? And that's what we're going to focus on. We're going to focus on helping you solve a problem, because with progress, you're going to be happy. You're going to do this more, and it's going to become a lifestyle. So Brian's not wrong with the math, but it's still really, what are you solving? That's where we have to meet you.
Yep. That's why you need to hop. That's why the best thing is to hop on a call and kind of dive into it and kind of roll up our sleeves a little bit. Let's see here. Another question. Oh, does qualifying for a HELOC depend on credit score? I think Joe was helping some folks with that too. Yes, it does. So is it 640 or 680, Joe?
690, 700. Get you 90% LTV and a 45% DTI.
DTI, debt to income ratio.
And you know, one of the coolest things about infinite banking, all that stuff that Joe said to get approved for, you don't ever need approval, folks. There ain't no hoops to jump through with infinite banking. It's your bank. You take the money out when you want, for what you want, as long as you have capitalized, meaning put money into your own system.
Yeah. So. And also, this came up. I want to share this because I don't think Joe's even heard me talk about this. This was super cool. Had a client, wanted to do a HELOC, but they knew what Joe had said. Oh, I can't do the DTI because I have 45. So I'm just going to do infinite banking, and maybe HELOC will be a dream down the road. And I'm like, well, what's the debt? They said it was like $25,000. Like, okay, how are you going to fund the policy? Well, I want to put in about 50 lump sum and a premium of like $12,000 per year. I'm like, well, did you know that when you do the funding of the policy and then move the debt from your creditors to your policy, your DTI changes? Because DTI is based on your credit score and your credit reports. What doesn't show up on your credit report? Infinite banking policy loans. So you move the debt from them to your policy. You're now in control of the debt. Your DTI now would approve you for HELOC. And they were literally just like speechless.
Yep. You move the credit score over to living inside the policy, and nobody can see the loans inside the policy. They can only see your credit score. And if you have 0 on your credit score, what does that mean? That means you can get qualified now.
Yep. So that was kind of cool. So we'll see what happens with that policy. But yeah, they completely changed their whole mindset, and that's what we do. We're helping you change your mindset. So kind of cool. Oh, Justin said here, this is for you, Joe, as well. I'm a realtor. Feel free to explain that further to see how it can help my clients. So imagine a realtor who can help clients get approved differently for a home, not just a traditional mortgage. That's
absolutely
cool.
Absolutely. That would definitely help them.
And what I appreciate about Justin's mindset, he's like, hey, teach me something. I want to learn. I understand I'm my most valuable asset, because if I know this, I can solve bigger problems for people. Can you imagine the world if we all came from that frame?
That's
just to
cool.
help one another.
Yeah.
The one word of caution I would have for, for Justin or really anybody is this first lien HELOC or all-in-one product we're talking about. It's a really useful tool, but in the wrong hands, it could be destructive. Because let's say you help somebody get into a home and you set them up in a first lien HELOC, and over some time they build up some equity and they start blowing it on crap. That it's basically an ATM, card for your house. And so you're going to just cause more issues. So I think this first lien HELOC is really a great product for people that are disciplined, that want to use that equity to build more money, put it to work in good places. So it's a great product. I would just kind of caution you that it's for everybody, because it's not.
Yeah.
Craig, thank you. I love that. And you're literally putting your own home up for, the collateral, right? So that's the danger there. And what you're saying is you really have to have the discipline. You have to have the mindset. And I think it's one of the things we talk about numbers all the time. We can show people mathematically how to get out of debt. We can show people how to have passive income, to replace their current income, to do all the things mathematically. But the other side of the equation is the mindset, the psychology. We talk about it a lot, the money mindset, but I still feel like it's a piece that people are just missing. They're not really focused on it. Like I was looking at some facts today and saw that we have climbed, like we were at 68% credit card debt, like people living paycheck to paycheck last year. We're at 78% a year later.
That's crazy right now.
That's shocking, right? Isn't that not shocking? 10% up in 1 year, people paycheck to paycheck, 78% of Americans.
Yep. I was at 125% one time. It's kind of hard to do. I don't recommend it, by the way, but I was making a lot of money doing that, though. So it was kind of don't do that, though.
Yeah, but I guess I would just kind of leave that discussion with, Justin could be in such a powerful position for the right people. Like, hey, you're gonna set yourself up right from the start. So yeah, check out the all-in-one first lien HELOC and just spend some time getting educated on that and share it.
Yeah,
with the right people.
Talk to Joe. Get a call with Joe.
Yep. Everybody call Joe.
Yeah, there you go. Call Joe. Got lots of time.
Joe's going to be a mortgage officer pretty soon too.
And make sure you send Joe an encrypted message, on a separate device that you have to unlock with a code.
Guys, I have a plate, not a platter. Settle down.
Hey, Joe, remember this? Is this thing on?
Yeah, I do.
Joe's our
gets busy.
resident technical expert. Jeremiah says, do you think that your credit score matters at judgment? And I think he's referring to at end of life. And no, it doesn't, of course. But the one thing about credit that a lot of people don't understand, and I've studied it to a small degree, credit scores are from private companies that are for profit. A lot of people don't understand that the three big ones, they're for-profit companies. They're private for profit, meaning there's not a government thing. And so there's a whole game you can play with credit scores. There's credit scores, by the way, and credit profile. You should know the two. They're very different, by the way. And different companies look at different ones, but they make money by selling your information. That's what they're doing. So once you kind of understand how credit score works, it's kind of a slimy game, to be honest. But it's a weird thing, but it is for profit, by the way. So keep that in mind.
Oh yeah.
All right.
And when you know the game, you can have them manipulate the the data that they're selling to the banks, and definitely look a lot better on that paper.
Oh yeah. And infinite banking is a way to play with that game. And I always say you got to play the credit score game to win. And credit profile is almost in some ways more important if you're in business than credit score. Credit profile is your history, right? And what it looks like and DTIs and all these things. You can have an 800 credit score and not get a mortgage or not get a loan because your profile is not good or doesn't have any history. So kind of keep that in mind, but that's a separate presentation. Okay, we can guess that, but yeah. All right. Peter said, if I have a mortgage that I am paying down with velocity banking, is it better to pay off mortgage with a HELOC or a cash value loan, or just keep velocity banking? Craig, you want to take that one?
Well, I mean, this is my perspective. I don't like paying off a mortgage because every time you put $1 into that mortgage, it kind of goes into a black hole and I can't get it out or use it unless I have a HELOC or I have a first lien HELOC. So we're kind of back to that discussion. So to me, the best situation is if you have that first lien HELOC, yeah, not a problem. Run money in and out of it. And if you don't have anything else to do with the money, then store it in the HELOC. So that would be the first thing that I would want to do. And that's actually what I do is I have a first lien HELOC and just run everything in and out of that. But is it better to pay off a mortgage with a HELOC or a cash value loan? You know, what are the rates looking like and what could you do with that cash value? So I know Joe and I are going to be on the same page with this as we would be looking at, can I put that cash value to work? Can I put that HELOC to work to create more money to pay that off, right? So I would consider taking the cash value and putting it to work, say in a private lending deal or whatever you know, like, and understand, to create more income. And then that could potentially pay down the line of credit or the HELOC or however you've got that set up.
The big thing in this whole section is if he pays down the mortgage, all of his money is still stuck in the 2x4s.
Yep.
He still doesn't have access to it. So it doesn't really, it's apples and bananas, because obviously if you use the HELOC, the money will not be stuck and be stagnant inside the 2x4s. If you do the IBC way and pay it down with infinite banking and velocity, doing it that way, you still don't have access to the money. So you can't even, that answer can't even be answered. Because you're either leaving the equity in the 2x4s or you're taking it out. So
let's make up a quick math equation for Peter, right? Both of what you guys said is just, it's so spot on every time you guys talk about it. But if you're going out, like Peter, say you have 50,000 and you put it into what Joe or Craig are talking about, like a hard money lending situation, and say it's at 12% for a year. That's $6,000 over a year, $500 a month, right? 6,000 divided by 12, $500. Now, if you have, that's the cash flow. We're talking about cash flow is always the underlying subject of what we're talking about. If you have like $200,000 that you're trying to pay down on your mortgage, and say your mortgage is, I don't know, $2,000 a month or we'll call it $1,500 a month on 200,000. Well, then if you're able to have that 200,000 in cash at some point, you could have 2,000 through that hard money lending situation, right? You have to look at what's creating more cash flow. Like if you're paying off $200,000 to save $1,500 or get $1,500 in cash flow, you could take that 200 and have it work someplace else and make you a bigger spread. So, and then there's the psychological side. Some people are just going to want to pay. Like my neighbor, he's hell bent on paying off his mortgage because of what happened to his grandfather and his uncle later in life. Like his number one thing in his life is paying off the mortgage. He even started a second company during the pandemic where he's clearing another 10 grand a month, working 2 days a week. All right. And just, that's what he wants to do. And I've explained this to him 90 times. So it doesn't matter, because for him, peace of mind comes from paying that off. So that's the other factor in this too. So
makes sense.
And, and part of that, Jason, I agree with that. Some people are just wired where they want that feeling of not having that debt associated with them. They're free and clear of that. But even with the first lien HELOC, let's say that you're in retirement, you want your house paid off. Would you rather have access to hundreds of thousands of dollars if you needed it versus having it locked up and then you can't get at it? So I still think, regardless of whether you're using it or not, it's a great tool to have available should you need it. Now, you know, a lot of us are going to say, well, let's take that money and put it to work and make more money. But even if you're more on the conservative side where you don't want to use it, I'd rather have access to it than having it locked up. So another thing just to consider about the whole first lien HELOC.
Hey, Craig, let me ask you a question.
Yeah.
Is your house paid off?
It was, but it's not anymore. But I could
Ah.
make it. I could make it anytime I want it to be.
With a snap of a finger. See what I mean?
Yeah.
My house has been paid off 4 times.
Yeah.
How did I do that?
4th of July.
Wow, you
That
did it
was
when you
cool.
said 4 times and celebrate. That's how Joe felt inside, everybody. AI is so smart and knows how Joe's feeling on the inside.
That's me inside. So your house is paid off, but because you have a HELOC, that money is in an investment. But if you called up that investor and said, "Give me my principal back," what's going to happen? Your house is paid off again. You put it in the HELOC, and you don't owe anything again.
Right.
So it's the best of both worlds.
Right.
Right, Chris?
I have no idea what you're talking about.
He's right. He's afraid to agree with you, Joe. That says a lot.
There we go. All right, what are the questions we got here? All right, J-Rock actually asked another question. Thank you. Any thoughts on pulling equity from a commercial office space and using it for a home purchase because you can't do a 1031?
Now you're dipping into a commercial line, utilizing a HELOC. You're not going to get a first position all-in-one HELOC like what we're talking about, except if it's a primary house. Now the rates are going to be higher depending on what the commercial loan is going to do. And now you're going to throw a whole bunch of curveballs into the mix.
So
Not
Joe's
only
saying
that-
too many variables? Too many variables.
A lot of variables, but now you're doing a business and you want to buy a primary residence. So now you're going back over the river. Now you got taxes involved and how the money is going to be utilized. So too many curveballs to
Over the river? What's over the river? Are we down by a river in a van? Like what over the river? What do you mean?
If you have your primary and your W-2, your personal stuff on one side, and you have your business and your LLC on the other side, there's a line in the middle. Once you cross the river, once you cross that line, well, now there's taxes to pay one side or the other. So now you're throwing other curveballs into the mix.
We got rivers and curveballs. What are we talking about? No,
You're commingling.
Not an enemy question.
You're commingling your dollars at that point.
he wants to know how you've paid off your house, but it's not paid off because of the HELOC.
Yeah. So I mean, so I've got the first lien HELOC, and let's say that I take the house is paid off, but then I take $100,000 out and I put it into a private lending deal, and now it's making me $1,000 a month. At the end of that private lending deal, I can just take that money and put it back in the house. House is paid off again. I can take that $100,000, $200,000, whatever it is, put it back to work. Once that deal is done, I can put it back into the house. So, part of it is I'm using the money from the equity in the house to go make more money, which goes back into the HELOC, which pays for itself over time. So one of my strategies is what I call freeing the capital. So for example, long-term, what I want to be able to do is get as much capital out deployed or, generating income that doesn't have a HELOC or a policy loan against it. So it's just free and clear. Let's say that I get to I'm 75 years old and I've got, several $100,000 out working free and clear, but I've got my equity back in my house. I've got my policy loans restored. Let's just say something bad happens to my private lending. A deal goes bad. My safety net is the HELOC. I still have access to that money if I need it. I've got a safety net in my policies. So that's just kind of how my mix is, because I've got that. I'm more conservative with not having every dollar out working, but I like to have that safety net. So really the way I can pay my house off is just take that money back out of the investment and put it back in the HELOC, and my house is paid off again.
No, I love how, and for everybody, like what Craig just said was magical, because he's talking about what his personal financial psychology is. He has the goal of financial freedom through investment, but he still is going to have multiple places where he has the cushion that he's comfortable with. So God forbid something happens, he's been working with this lender and developer for years and years. And all of a sudden they go to a country like Belgium where he can't be extradited with all Craig's money.
Oh,
right?
I'll track it down.
I'm saying, like, every investment, no matter how secure it feels and how good the person is and everything, it always comes with risk. It's just the definition of investment.
Yeah. And
so with infinite banking, I had someone ask me today, it was the first IUL actually that I've seen. The lady put check this out, guys. I'm glad that this came up or it popped into my head. She's in her 60s. She's had an IUL for 10 years, and you're all thinking, oh, what's he going to say? It's terrible. But she put $100,000 in year one, and now she has $143,000 of cash value in the policy with no surrender charge. And now the last couple of years, it's been giving her not much. It's been going down a little bit. But just think, I mean, she's got a $43,000 return in that policy. She's probably rolling it into a whole life because she has some other plans for it. But I was pretty excited. I actually talked to someone that wasn't losing everything with an IUL. So
he said, can a HELOC be used to purchase investment properties or only personal homestead?
We did not address that, but I know there's the mortgage company I work with is CMG Mortgage. That's who I got my all-in-one through. I know that they will offer a first lien HELOC on rentals, so that might be something to check out, Justin, if you're trying to find a first lien HELOC on investment properties. And Joe, is the bank that you're working with, are they also going to be doing this on investment properties?
To come.
Okay.
In the near future.
Okay.
Yeah. That's what we're working on.
Yep. So you've got some options. There are some companies out there that will do it, but not as many that will do it on personal.
Cool. Oh, Peter just said he got the email with the final approval from underwriting for his HELOC. It'll be closing soon, so that's awesome. Congrats, Peter.
Yes. And we got some comments like these guys are legit. We appreciate that.
Yeah.
Right. So
who's that guy with Joe?
We got a Joe from Hope. All right. We got someone asking what a money Jedi was earlier. It just I believe behind that big sign right here is a painting of Darth Vader. I believe that represents the banking system, Wall Street. That's the evil empire. That's the one that's keeping people downtrodden, depressed, not having money, financially insecure. And then I believe the Jedis is what we all are. We're out here to help bring truth, light, and show people a better way if they're willing to shift that paradigm and take that journey. So
Ed asked a question. So you can get a HELOC on a property owned by a business or only available to primary homeowners?
That is similar to what Justin asked in terms of investment properties. So CMG Mortgage is one of the companies I know, and Joe, the bank Joe works with, should be coming on board as well. But they do offer first lien HELOCs on investment properties. So that might be something to check out with them. Which
is interesting because HELOC's home equity line of credit, just by in the name, right? We say a lot of the things with insurance is exactly what the name says it is, And so when you have HELOC, I've never heard of one on a property before, like on a commercial property, that is. So don't know if that's a thing, but you guys would know more than me. I just thought that was interesting as far as the name, right? So
yeah. Good question here. So Sarah asked this question. This has come up in many of my calls too, so I'd love to have Joe and others give some input on it. So Sarah said, explain how I can use a second position HELOC to pay off my mortgage. I'm not ready to give up my 2.7% rate on my current loan.
Sarah, is the loan on your, I'm just wondering if that's on your regular mortgage or is that on your HELOC? Just
no, it's a mortgage. So she has a mortgage right now at 2.7%. She's asking how would a HELOC that takes over the mortgage of 2.7% make sense? I think is what she's asking.
I wonder what year, Sarah, if you could tell us what year, just for Joe and for Craig, what year are you in as far as your mortgage goes? Are you in year 3, 4, 5? Like how far along? You look really young in your picture. So how far along are you in this mortgage? Because then they'll give you some facts. It'll kind of it might shock you. It might ask you to go through something, a little exercise. And if I looked at it earlier today, my wife was looking at it and she's like, is this for real? Like we have this much going to interest and this much going to principal. So guys, please expand upon that. So
yeah,
that's the difference between amortization and simple interest. 3% amortized is equivalent to 12% simple interest. So if you can get a HELOC less than 12%, That's 3% amortized. And especially if you're within the first 7 years. How long, how is it 7, Craig, before we go 50-50?
It's typically longer than that. I mean, the first 7 years, you're typically going to be, 70% volume of interest at least.
To interest.
Yeah, 70 to 80%. Yeah.
And that kind of drives back to the question Jason was asking about how old is the loan itself? Because if it's a new loan and you're still early on in that volume game of interest, you're probably paying 70 to 80% interest right now of every payment, maybe 70%. So that's another thing to look at is we are trained to think this way and we're so focused on rates, but we need to be thinking about the volumes of interest that you pay. And what I mean by this is, so Sarah, if you look at your mortgage and it's 2.7%, and you look at your payment that you're putting into the mortgage every month, let's say it's $1,000, just to keep it simple math, maybe $700 is going to interest and $300 is going to principal. So for the first 7 years, you're hardly even buying down the principal on the home. Whereas in a first lien HELOC, your 100% of your payment's going to principal, and then they calculate interest. So it's a completely different game. So we want to look at the volumes of interest that you're paying in different situations as opposed to the rates.
Yeah. Yeah. Because even Davey said here, he goes, I gave up 2.25 and it makes sense. So he has less interest than Sarah has, and he gave it up because it makes sense, like they just said. I mean, interest is just one part of the overall picture, but when you look at the cash flow, the numbers, all of a sudden the interest starts to get kind of less of a focus.
Yeah. And Sarah, I don't want you to, I'm going to give you a little homework. You can choose to do it or not, but when you do it, just remember it was Joe that told you to do the homework. Okay. It wasn't Jason, it was Joe. So yes. So you got it already. So you're going to go, you're going to pull up your mortgage statement. You're going to look at it and you're going to look how much is going to the principal and how much is going to the interest. I guarantee on, 200,000, if you're around.
Well, that's equity.
Okay. That's her equity. Okay. So her
more than 200,000 loan.
Yeah. So like, let's just say your loan's 300,000 and you're paying 2,000 a month. You probably have 70% of that or more going towards interest if you're only in year 3. I looked at it today for my own because we're doing the first, lien HELOC, and it's shocking. Like I said, my wife was very upset when she saw it. So again, Sarah, it was Joe, Mr. HELOC, that told you to go do that, not Jason. So that's your homework if you choose to take it.
So if you think you were upset now, how upset do you think I was back in 2010 when I had 2 mortgages in front of me and I was trying to figure it out? I almost fell off the chair. I threw it down. I ran into the bank and I says, I need a HELOC. I want simple interest. I paid off the duplex and we spun that around, and a year and a half that was gone, and then a year and a half later the big one was gone. So and
I can see Chris standing in the background thinking, Joe, sometimes, you've proven that anyone can do this and anyone can learn, because I remember when you started Infinite Banking, what a pain in the ass you were, and how you wanted to buy your new Cadillac with cash and you didn't want to put it through a policy. You didn't want to have payments and all those things. True? That's what Chris was thinking a second ago.
Ask him, out of the 12,000 clients, who was the biggest pain in the ass? Hi.
So that's more of everyone out there comfort. If you're thinking that you can't do this, you can. You can.
Yeah.
So the other thing I want to add about Sarah's question. So if let's say she's got 200,000 in equity, and just to keep it simple, let's say she can deploy 200,000 in a 12% investment. What's that? 2,000 a month in income that she'll be generating
a month. Yep, and she would be able to pay off the house and have somebody else pay for it.
Yeah. So is going from your traditional mortgage to a all-in-one or a first lien HELOC going to increase your payment $2,000? No. But now you can create $2,000 and run that back into the mortgage to help pay it down faster. So you're using your money just laying around your house to actually pay it off faster.
Cash flow, yep. Yeah. So actually, so another person, Oren, asked, he wants to get a first lien HELOC, but he screwed up his credit, so can't get one. He's in year 3 of I'm assuming a mortgage. How can I get to that equity? Well,
learn how to fix your credit, man.
Yeah, I was going to say, it's like got to fix the credit. I mean, that's you got to play that game. So it all depends on what's going on with the credit, though. But there are ways to fix your credit. There really are. It can take some time, but I have about 3 different acquaintances, friends that I know that's what they do all day long is help people fix credit. So you can do it yourself. You can learn how to do it, or you can get help to do it, but it depends on what the issue is. And of course, we don't know that. So Eve is asking, do you have a spreadsheet to share to compare a current home loan to a simple interest one? So that's a great question. So I always recommend it. If you want to know how to run numbers, you can build your spreadsheets, or if it's something simple like that, go to dinkytown.net and you'll find the calculators there. And yes, it is a goofy name, but it's dinkytown.net. They have hundreds of calculators, and just go find one for a mortgage and one for simple interest, and you'll be able to do the math there. But it's a phenomenal website. And in fact, I had somebody on our team tell me, "Oh, go to this other website to run this calculator," and it was a dinkytown.net calculator rebranded. And so, if you find calculators out there, a lot of times they're going to be coming from that website. And I've done the same thing for my businesses, where I'll buy their calculators and put them on my sites and brand it as my own, but it's always theirs. So Daley's Sullivan said, we don't know how to access our equity, the loan officer, and then it cuts off. So not quite sure what you were saying there. But yeah, loan officers aren't going to always know what we just talked about. So keep that in mind, right? They might know one thing and that's it, but it might not be the best thing for you. So yeah, always keep that in mind. So Linus has his helper right there in his lap.
She's adorable. Hello. Hello, do we scare you?
She's learning while she's young. Learning while they're young. That's awesome. I love that. Ooh, Jason had a question here. My interest is accruing in my life insurance because I pulled from it to pay up my pension that I borrowed from years ago. Came into some money. Do I pay back the interest first, the principal, or LPUAs, lump sum paid up additions? So, okay, interest is accruing in his life insurance because he pulled from it to pay his pension that he borrowed from years ago. Came into some money. Do I pay back the interest first, the principal, or the LPUAs?
So there's a conservative approach you could take where if you're like me, I wouldn't want the interest to continue to compound and grow. And I don't know how much you're dealing with here, but I always like to get the money in the premium side. So the LPUA would be my first play, but you might want to keep some around just to pay off some of the loan interest, depending on how long it's been there and accruing. So for me, it would be LPUA would be the most beneficial. However, if my loan interest is there, I'd want to know kind of what that looks like, and I might pay some of the loan interest. But we could always kind of look at your numbers and try to figure out. And Jason, I don't know if you have, if you're working with our team, but you should have an implementation specialist to reach out to your money mentor, and they can typically help you kind of solve some of those problems. Yeah,
and also when you're doing the LPUAs, I mean, is it on a new policy? Is it I'm not sure what the question is on that one either.
Yeah, like how old? That's a good point. How old's the policy? Like how much of a return are you getting on the LPUA, right? So
yeah, because you might be past the date of putting any more in. Depends on the structure of the policy, all that kind of stuff. Okay.
I'm gonna jump, guys. I gotta go.
Yeah, I think we did it too. We made it to the end.
Did we make it to the end?
We made it to the end, Joe.
Awesome.
So this is another Ask Me Anything. Put your question. Send us your questions during the week if they pop in your head, because they're going to. You've been here watching. Now when you have new questions, send them to us. We'll start with them next week. We look forward to seeing you next week. Anybody else have anything else? Otherwise, we are done for today.
Yeah, that's going to be heading out to PMC in Utah. We'll see you in a couple days.
Yep. Also, guys, grab a time with a mentor if you have any other questions. And we're here to help.
Remember, if you're enjoying the content here, go ahead and smash the like button, subscribe if you're new, and ring the bell to be alerted for new content. Watch the next video right here that's going to help you on your infinite banking journey, and I'll see you soon.